Good morning, traders. Welcome to your 7-minute market update utilizing technical analysis to predict direction based on human emotion. Today is September 15th, 2012. Lots to talk about, so let's get started. Please forgive me if I do sound a little groggy. It is 6 o'clock in the morning here, but I wanted to do the best I can to get this video out as soon as possible. Um, this is the chart of the SPY, which is the ETF that tracks the S&P 500. This is actually the 10-minute chart. And again, in a lot of my videos, what I want to do is I want to tell you what the chart's telling, meaning what the charts are telling me, what it's talking to me about, what it's trying to tell me what's going to happen, and of course my own opinion at the end of the video of what I think is going to happen. In any case, let's do a quick recap here. From back this day here, I think it was this day here. Let me just zoom in. This was on Wednesday when we had the Germany announcement, or the German ruling on if they were going to support their type of quantitative easing. And basically what happened was, after the release of news, it was just a basic sideways day. It wasn't any a big news or anything like that. Pretty much what people were waiting for was Thursday, which was Uncle Ben's announcement of possible QE3. QE3 is a quantitative easing, if you didn't know what that meant, and that means printing of money, all right, or that's basically what it is, printing more money and devaluing the dollar, in turn propping the markets higher. All right, so anyways, this green line, this dotted line here is the start of the Thursday day, and then we just basically traded sideways. And as soon as Uncle Ben said we are doing QE3, we get this huge spike, boom, 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 which is pretty expected of QE3, because it's a reputation of the stock market having a quantitative easing as some sort of drug. We talked about this in the previous videos that anytime you have a QE3, the markets just love that, and they'll just keep on buying in and propping the markets higher. In addition to that, the Feds and the institutions are the ones that are propping the markets higher, because they can definitely are the ones that can, because they have all the money to do it. All right, so bottom line is, after he released QE3, the market just continued higher and higher and higher. Now think about this: the QE3 is a quantitative easing with no end. Okay, well, I'll get that to get to that after this video. In any case, I had this level here, which was 147.05, and you can review the previous, I think it was the past 3 videos. I already had this 147.05 in place. And interestingly enough, the SPY went all the way up straight into the 147.04. So this calculated level here was 1 penny off before we got an intraday pullback. Okay, so that's pretty cool, because I love to see these levels work out. And again, these pink lines here are mathematically calculated levels that it's not something I can take credit for. It's just a formula that I've created, that when I put numbers in it, it spits out these numbers, and for whatever reason, price just goes into it before either getting a bounce or getting a pullback. And it's been working out pretty well. The way these mathematically calculated levels work is 3 different things. First thing is, and this is the one you have to watch out for, is that it could gap into it or on it. What I mean by that is, for example, if we had closed here on Wednesday, this mathematically calculated level, we'll see sometimes a gap right onto it, meaning it'll start from this mathematically calculated level before going higher. Okay, that can happen. The second thing that can happen on these mathematically calculated levels is a intraday pullback. Okay, so intraday is what happened on Wednesday. So normally, if the volume is low or you have some big news like quantitative easing, you'll get an intraday pullback, but then it will be short-lived, and that's pretty much what we saw. So we got this intraday pullback. It had this small pullback, which was perfect, absolutely perfect for an intraday play, and then we broke through it the next day. Okay, and then of course the third thing that these mathematically calculated levels will do is it'll pull back for multiple days. So for a swing trade, it'll still work for that. All right. So obviously, the reason why I use other things like Fibonacci retracements, pivot points, and trend lines in combination with the 147.05 or any other mathematically calculated levels will increase the odds and put it in my favor that the pullback should be a little bit longer lasting than your normal intraday, and or to prevent any possible gaps. Now, gaps will happen if you have news the night before or after the market closes the day before. That normally happens during the after day not the after day, the after hour or the pre-market trading, then you'll have normally a gap up or a gap down depending on what the news is or what's happening. But for whatever reason, these levels work out pretty well for those three different things. In any case, moving on. Okay, so moving into Friday, we see that we punch a little higher, we come back down, we come close to this 147.05, not really. The low here was 147.16, we come back down, we went right into this 147.05 again, we get a small bounce, intraday bounce. It wasn't really that much of a good intraday bounce, but as you can see here, we had the 20 moving average just gleaming right over it, which means that, you know, even though you had this level here, it wouldn't have held up pretty good, pretty well as far as the intraday bounce, and sure enough, it kind of just traded right under this 20 moving average before breaking down. And then we traded right under the 147.05, and the very last 10 minutes we get this spike towards the end of the day, and we all know and we always see these kind of actions happen on the 10-minute charts or the intraday, and you know, you can just that's pretty much expected for a market like the one we have now, where we have a lot of federal manipulation. And I don't know if I would call it federal manipulation, because it's just a common thing that we see. So is it really manipulated? Yeah, it is, but I mean, it's expected, and I wouldn't, you know, make a trade on the expectation, but because the odds aren't enough in my favor. I mean, they'll shoot it up towards the end of the day, or they'll shoot it down, but more than likely, now that we have QE3, they'll probably save it towards the end of the day because they can. Okay. All right, switching back to the daily chart, or to the daily chart at SPY. What we have here is this rising wedge here, and I said it's very not unlikely, but it's very unusual that we would actually get a breakout from a rising wedge pattern. I mean, that's a rare thing to see. But I'm about to show you something that's a little bit interesting that that might catch your eye as far as TA goes. Okay. But before we do that, we have this breakout, which is the QE3 news. We went right into the 147.05 before having that intraday pullback that we saw in the 10-minute chart. But we did it on high volume, and this basically means that this move here is a valid move. Price is validated by volume, and that's exactly what we had on Thursday. But on Friday, you notice we have somewhat of a shooting star pattern here. Now, shooting star pattern normally happens after you have, you know, a up move like this one here, a up move like this one here, and a up move like this one here, and so on and so forth. You see how these patterns work. You know what I'm talking about. This pattern was actually an up move. We had a consolidation. We had a up 1 day up move, we consolidated to the side, and then we went up again. So this could potentially mean we may consolidate again before moving higher, and that would not surprise me, simply because of QE3. Now, QE3 again is like a drug, and even if the markets decide to pull back, the Feds will do everything possible to prop the markets back up, and it's because of the QE3. I mean, QE3 is basically printing money. When you print money, it devalues the dollar, and when the dollar goes down, the markets go up. I mean, we've been seeing that for years now. I do have another level here. Oh, so before I move to there, this shooting star indicates a possible short-term reversal. Okay, so if you are short here, then, you know, the charts are saying that we have a short-term reversal, possibly starting on Tuesday, because Monday is a low volume day, so we may float or move sidewards, you know, maybe halfway, or you know, right at the high of that candle there, which was Friday. Now, this is the way I would play it. If for some reason, let me kind of just zoom in here if I can get it there. Okay, so if for some reason on Monday we close above this candle here, then in my opinion, this pattern here is negated, meaning it is no longer a shooting star, and we will not expect a pullback at this level here. Maybe a little bit higher, but not at this level. Okay. Now, if we don't close above this candle here, remember, it's got to close above the high of this candle here. Say we close around the middle or whatever, then it's still in play, because Monday, you got to remember, is a low volume day. A low volume day, you have to give the upside bias, simply because the institutions have the ability to prop the markets higher with less money, because there's not enough sellers in the market, right? So if that happens, then they can just float the market higher, or at least to the side. All right. I mean, we are in an overbought situation right now, but with QE3, you just never know. Now, What I do expect on Tuesday towards Wednesday is a small, somewhat of a pullback. And the pullback, I don't know how short-lived it will be, but again, and like I've talked in previous videos, you don't want to trade against the trend. Right now, the trend is up. Nothing's telling me otherwise. So if you're going to do a counter trend trade, then you have to be cautious. And as soon as you're in the money, you put a break-even stop, and then you get in and you get out as soon as possible because this thing has the potential of shooting higher. Now, how much higher do I think it could go? Well, let me just zoom out here. 157 is another and my very last mathematically calculated level. What do I mean by that? Well, my calculations are based on a specific pattern that the markets and or stocks will always make. Okay, always. But this pattern, based off this specific pattern, I get the numbers, and then obviously after I input the numbers into the calculation, it spits out these pink line numbers. Okay, so these numbers here, 147.05, 141, etc., like the 129.92 was calculated on this day here because that's where I started the line. 147.05 was calculated on the same day on 141.58. The 157 was calculated all the way up on this day, which was Friday, simply because I didn't really think that we would get to a 157 level. I really don't think. In fact, right now it's hard to believe we'll get to 157, but again, with that crack-induced QE3, it is definitely possible. In addition to that, we have the election year, so Uncle Ben will do everything possible to get a certain someone re-elected again because he was the one that appointed him in the first place. You see what I'm saying? So it is in the best interest for Uncle Ben to have the same person who appointed him to get reelected, if you know what I'm talking about, right? And one way of doing that is to manipulate the markets higher so they can say, well, when I got elected, the price of the markets was this, and now it's this, so I'm doing an awesome job, and the economy is doing 100 times better. But the reality is the public, the general public doesn't know that what they're really doing is devaluing the dollar, and the US dollar is just going to be worth nothing pretty soon, and we'll have to go to a gold standard, blah, blah, blah. Anyways, get back to the charts. The next level I have up here is 157 even. It's an even number. It's rare that I get an even number in these calculations. Can we get all the way up there? I have no idea. But again, these calculations are based on if we get there, then I'm taking a short. That's what it's based on. What do I mean by that? Well, if we go straight into it, almost get to it, and then we kind of consolidate sideways, I will not take the trade if we get here. Why? Because it's building consolidation, it's building power to break through any other type of possible resistance, and therefore the 157 is off the table, and I will have no more mathematically calculated levels after that unless I get it from years ago. Okay, maybe a bigger time span. In any case, another reason why I think the 157 level is a substantial level if we can get there for at least a correction or a pullback. And what do I mean by that? Well, by the time we get here, maybe the election is over, and once the election is over, they could care less if the markets come down or not, because he's got another 4-year term, or a new person would have starting a 4-year term. You know what I'm saying? You know what I mean? So anyways, let's get back to the charts here. Let me load this drawings here. Let me show you what I see. I see 3 trend lines coming right into this 157 level. You see that? This gives even a more substantial it gives it more credibility that we may pull back off this 157 level. And let me just zoom out here and show you why. Okay, this is the weekly chart of the SPY. Let me just let's see, let's do this here. Let me just make it so I can zoom out a little bit more. There we go. Okay, so we have this trend line here. We have a pivot point here, and all I'm doing is all you need is 2 pivot points to draw a trend line, right? So after these pivot points, we have this pivot point, we have this pivot point. This validates this up rising trend line here, and it goes right into this 157 level. We have a pivot here, we have a pivot here, right? Pivot here, and remember this is the weekly chart. We have a pivot here. On the weekly chart, we broke down, but this trend line is still valid, and it goes into this 157 level. Alright, so that's pretty interesting. Now we also have this pivot here. Again, all you need is 2 pivots to make a trend line. Another pivot here. This is a little bit of a shorter term trend line, but it also goes into this 157 level. So that's 3 trend lines that I see that goes right into the 157 level. So that tells me that if it gets into the 157 level, and let's just say it happens to be after the election, then basically what happens is I do expect a correction at that point, and it could be, you know, a pretty good correction where we actually end up back to this 147.05 level, and that's a 10-point drop. Okay, and that's not unusual for a correction to have, you know, a 6-7% drop. Okay, now what I'm gonna also show you is this. This is pretty cool. Let me delete all my drawings here so we have a fresh chart. And now this is still the weekly chart here. And let me kind of just zoom in just so I can get what I need to see here. Alright, so now earlier in the video I said, okay, normally you do not break above a rising wedge pattern, right? It's not a normal thing to see. And in a lot of cases when this happens, let me just zoom in just for now, these patterns fail, and a lot of times they will break back down into the pattern, and that is very bearish if it does that, and then it'll just continue down, retest the trend line here, and then head lower. But again, with QE3 I can't have that as an expectation, but that is what I normally do see in charts. But let's take a look at the longer term here and see if we can find anything else. Alright, let's take a look at this. If I get my drawing tool here and then I draw a trend line connecting this pivot here to this pivot here, we have this trend line. Actually, I can go all the way up to the body almost. Okay. Now, I'll grab the same pivot points that I showed you earlier, which was this pivot point here. I'll connect the dots, this pivot point here, this pivot point here, this pivot point, so on and so forth. I'll just draw a line straight across. And now we have a rising wedge type pattern with no tip. You see that? An ascending triangle has a tip, but this is a rising wedge with no end basically. So what I do see is a potential of this guy continuing higher, and now it doesn't look like, in my opinion, a rising wedge that needs to break out. You know what I mean? This actually looks like a normal pattern if you look at it in a bigger time span, right? Whoops, let me just redraw that line back in there. So again, there is a potential we reach this upper trend line here before getting a pullback, and that pullback could bring us all the way back down to possibly the 137 level by the beginning of next year. That is a possibility, not a probability, but this is definitely what the charts are telling me on a bigger time span. Okay. So basically what the charts are telling me is this. We had high volume on Thursday's news, which was good because it validated the price. We created a shooting star candle on Friday, which indicates a possible pullback, but I don't think it's going to be long-lived. It'll be short-lived in my opinion. And then you know, we should head higher, possibly, maybe to the 157 level. It's not going to get there very quickly, in my opinion, but it's possible that it will, and if it does, then I'm taking a short. Other than that, though, I'll be looking for long positions. What do I mean by that? If this guy pulls back, then I'll probably go long the SPY. And that's that. Okay, so let's quickly switch to the dollar and see what that chart's telling us. Alright, this is the daily chart of the US dollar futures, and if you take a look at this, let me just zoom in here. We had this down move. Let me just delete these lines. I don't even know why they're in there. It broke through this trend line here that we had in this previous video, and interestingly enough, it went right into the $78.74 level before getting a bounce. The low of this candle was actually 78.725, which was 78.73, and that means it's 1 penny off. Now the dollar, this is the cool part. The dollar is not dollar for dollar, meaning dollar up, markets down $1. It's tick for tick. So the cool part about this is, even though this mathematically calculated level was 78.74 and the SPY was a different level on the upside, they both held up, which was pretty cool. I mean, I really like seeing these levels hold up. So in any case, the dollar held up. We had an intraday bounce on the 78.74. What remains to be seen is if we actually get a bounce, a short-term bounce off the dollar, which would mean a pullback off the SPY, and then that will set us up for another bullish move higher, in which case I gotta find some stocks with you know, some bullish patterns. Now let me kind of just zoom in here. We have this green line here. Let me just show you what that means. This is the weekly chart of the US dollar futures. We have this pivot point here. Actually, I should be able to redraw this a little bit better. And we have this pivot point here, and it just so happens to go right into the 76.38 level, which is telling me that there's a possibility, just like that 157 level on the SPY, that the dollar can get all the way down to the 76.38. Again, if the dollar just gets hammered all the way in here, then I'll take a long trade or a short trade on the SPY. Um, um, Long trade on the dollar or a short trade on the SPY if the dollar ever gets to this level here. Okay, so that's the US dollar. Alright, now this is the chart of the GLD. This is the last chart I'll be talking about today. I normally just talk about the market, but I think this is something that we should really watch out for, because gold is an inflation and deflation indicator. Basically, when we have inflation in the markets, gold will go higher. If we have deflation, the market gold will go lower. So if we see the gold go lower, the market's going higher, then that gives us a signal that the markets could potentially start coming back down. In any case, I just wanted to show you the gold chart here. This is the weekly chart of gold, and it's just had a run all the way up. Okay, I mean, it's just been straight up like an arrow. Gold is definitely in a overbought, overextended area right now. I don't think it's just going to be a correction in gold, but a pullback is definitely in the cards right now. So my level for gold, or the GOD, which is the ETF that tracks gold, is 174.29. Now you see this pink level here, and then you have these two kind of dull yellow levels here. Let me just switch to the daily chart and show you what I'm talking about. Alright, this is the daily chart of gold, and gold already created a doji-like candle. Okay, so this indicates a possible pullback already. It went right into this 172.38 level, and it could already pull back. But this 172.38 level I can't take credit for, because this is the level that I'm actually looking at as a pullback. What do I mean by that? Well, I have an alert here for 173.97, which means it'll send me an alert saying that gold is getting close to the 174.29 level. And if it does get close to the 174.29, meaning if it gets to the 174 level or anything after that, I'll probably take a short trade on the GOD for a short-term pullback. Again, it'll be a counter-trend trade, obviously, because we're going to have inflation due to QE3, so I do expect gold to go higher. But how much lower do I expect gold to go? And then that's why I have this level here at 172.38. This is a mathematically calculated level based on if gold bounces off this 174.29 level. I wonder if I took it off the right levels. Well, in any case, if I do change this, I'll create another video. But for now, if we get a bounce off of this 174.29 level, meaning this doji candle does not hold, we may already get a pullback. If we get a pullback, then this 174.29 is off the table, meaning there's no play on that, in my opinion. But say intraday we get a spike or a gap into this 174.29 level, I take a short trade on gold all the way back down to this 172.38 level. Okay, and then I would probably sell some of my shares there, and then see if we can get all the way down to this 165.29 165.49 mathematically calculated level, which is also happens to be this gap fill level here. Okay, a lot of times ETFs and stocks like to go back to where they came from as far as gaps go, and then definitely sell the rest of my shares here before expecting a bounce higher in the GOD. So what I think, though, if this 172.38 level is valid, let me just take a quick look at that again. But if we get into this 174.29 level, and then we go into this 172.38 level, then I'll probably, because it is a counter trend trade, so say it goes up here, comes down into this level, counter trend trade, I take $2 off the table, sell all my shares, and then turn it around and go long on the gold chart. Okay, so that's pretty much what I'm looking at now. You know what? Instead of waiting for the next video, let me just validate these calculations right now. Just give me 1 second. I'll be right back. Alright, it's a good thing I checked, because the calculations were off, and this is provided we get into this 174.29. If we get into this 174.29 and we get a bounce off of that, then the next price I would sell it at is at 172.67, and that's due to a counter trend trade on the GOD. Okay, so that's pretty much all I have. One more thing I wanted to mention before I end this video is just keep in mind that next week is the week that options expire. Okay, so options will expire next week Friday, which is the third Friday of every month. And when options expire, or that week that options do expire, we normally, on a normal month, is normally it's very, very volatile, meaning institutions are going to try to stop people out on the long side and on the short side. So they're just going to whip the markets back and forth, and it's because they have that kind of money to do so. So just be on guard, because it's going to be a very volatile week next week. It is when the institutions, when they play games, that is the week they're going to play games, because every third week of every month is options expiration. And let me explain to you what I'm talking about. If you're not familiar with options contracts, it's what I used to play before, but I don't play with it anymore because it's a rigged. It is a very maybe I shouldn't say rigged. Maybe I should just say it's a very complex thing to do. I mean, you have all your Greeks you have to worry about. You have your delta, your theta, your vega, and those all play into how much your options or your contracts are worth. Yes, it gives you the leverage, but it also puts you in a higher risk situation. And in any case, if you go down just to the very basics of options trading, you have puts and you have calls. You have puts if you're short, you have calls if you're long. Right now, everybody due to QE3 is long the market. Okay, think about it, right? Everybody is obviously bullish, so all these calls are being bought. Now, before the expiration day, which is Friday, institutions are going to try and stop people out. Maybe you know, push the markets lower to get people thinking that the calls are going to be worthless by the time Friday. So they either stop themselves out, or they dump their contracts back and sell it back to the institutions, because the reality is there's a lot of contract writers, but the main majority of all the contracts that are being written, I'd say 90% of the contracts that are being written, are from institutions, hedge funds, and stuff like that, the ones that are going to play the games with you. They cannot lose money. They don't want to lose money, so they want you to stop out, and they want you to dump your contracts, so there's no way that you can execute it or resell it for a value. Okay, so just keep that in mind, that next week Monday is going to be the start of options, the week that options expire, and it's normally a very volatile week. So having a small pullback next week would not surprise me, because everybody's bullish. Okay, so just keep that in mind. In any case, this is your weekly update, or your weekly 7-minute market update. God bless to you all. Thanks for watching this video. I really appreciate you guys stopping by, and I hope you guys all have a great weekend. And I will see you in the markets next week, hopefully in the next video. Have a good day.